Well, it was a blowout April jobs report with 263,000 jobs added to the U.S. economy and the unemployment rate falling to 3.6%. Now, Morgan Stanley economists noting that most of those jobs, though, were created in lower paying sectors, including hospitality and business services, leading to a 0.2% increase in average hourly wages. Joining us now is Joe Song, U.S. economist at Bank of America. And Joe, when you take a look at this report, I guess first, just what is your overall reaction to it? Do you think that this is a Goldilocks report for the equity market?
Yeah, I think that's exactly right. I think this also dismisses the notion that the U.S. economy is heading into a downturn, right? You had broad-based job gains across the board, both in goods producing and service providing sectors. I guess if there is one area where you could say the report was a little soft was on the wage gains, right? Mm-hmm. So you've had year-over-year wage growth kind of move sideways over the past few months. But I think relative to where trend productivity growth is, they're still at good levels.
What do you think we need to see in order to get that average hourly wages number up? Because it's a number that we have been talking about now for months and months and months. And the fact that we saw year-over-year growth of 3.2%, some people are saying, like you just stated, that was a little bit disappointing factor in today's report.
That's right. I think what it tells us is that there might be more shadow slack in the economy, right? So that means that the unemployment rate might have to track down a little lower for inflation to show up. So thinking about the structure of the labor market, the demographic is much older, right? So it might take a little bit more reduction in slack to actually start to see those wage pressures in the economy.
Joe, once we dug through and took a look at some of the sectors, manufacturing, that's a sector that jumped out to me. Only 4,000 jobs were created in the manufacturing sector for the month of April. We also just got the ISM report earlier this week. What's going on there, and how significant do you think this is?
Yeah, I mean, we are clearly seeing a bit of a slowdown in the manufacturing sector, but I don't think it's an outright decline, right? Mm-hmm. So I think there's also transitory factors going on. We also had the polar vortex in February that shut down some of the auto factories. There's also auto retooling that goes on at this time of the year, where they try to build out for the new brands. On top of that, you've had disruptions at the border, right? You had the U.S.-Mexico border disruptions. That's actually increasing the time that supplies are getting to the factory. So all those things are kind of slowing down manufacturing activity. But overall, we do expect manufacturing activity to slow a bit this year, and it's consistent with our growth numbers to be moderate around 2%.
Joe, we've heard from President Trump recently. We've heard from other members of the Trump administration. They seem pretty unified in the fact that they want to see a rate cut when it comes to the Fed's next move. Yep. In terms of what you've been seeing, obviously it's an independent institution, but what do you think the Fed's likely next move will be? Because on the heels of this very strong jobs report, it's hard to argue, I think, for a rate cut at this point.
Yeah, I think the Fed is in a good spot. I think they're going to be in an indefinite hold for some time until they see otherwise from the data. And that's what you've been hearing from all the main Fed officials, right? Chair Powell came out on Wednesday basically saying policy's in a good spot. They don't see any strong reasons to move rates up or down. You also heard Vice Chair Clarida this morning talk about that. They're going to let the data speak to them. So I think for now they're going to stay on hold. If inflationary pressures build up, then they might consider raising rates. If they start to see that falter, or if they see the growth data falter, maybe they'll start considering rate cuts at that point.
And real quick, Joe, just one more thing. Labor market is very tight right now. We talk about the fact that unemployment down to 3.6%. It's good news for workers out there looking for jobs, but for a lot of employers, they simply aren't able to find the workers in order to fill those positions.
Yeah, so a lot of businesses are moving to automation because of that. So that we're hoping that actually generates a bit more business investment this year, and hopefully that will lead to better manufacturing activity in 2019.
All right, Joe Song, thanks so much for coming in today.
Pleasure.